Hello, everyone, and welcome to Financial Accounting. Our topic today is plant assets. We're going to look at the three major plant asset categories: tangible assets, intangible assets, and natural resources, and how to determine the cost of plant assets. We will also discuss the difference between capital and revenue expenditures. Finally, we will look at how assets are depreciated. Plant assets represent a bundle of future services and can be thought of as long-term prepaid expenses. They are tangible assets that are actively used in business operations. It is expected that these assets, sometimes referred to as property, plant, and equipment, will benefit future periods. A plant asset is recorded at its historical cost when acquired. Plant assets are increased by debit and decreased by credit. When a purchase is recorded, we debit a plant asset or property, plant, and equipment account and credit cash, accounts payable, or notes payable, depending on the purchase agreement. Once the asset is placed in service, a portion of the asset's cost is allocated to depreciation expense as the asset becomes older. We already briefly looked at how depreciation is recorded in the video called The Accounting Cycle: Reporting Financial Results. If you haven't had a chance to watch this video, the link is in the upper right corner, and I will also post it in the description to this video. Tangible plant assets are long-term assets that have physical substance. Examples include land, buildings, equipment, furniture, and fixtures. Intangible assets are non-current assets with no physical substance. Examples include patents, copyrights, trademarks, franchises, and goodwill. Natural resources are acquired for extracting valuable resources to be used in the business. Examples include oil reserves, timber, and other minerals. When a plant asset is acquired, it is recorded at its historical cost. The next slide will show how this cost is determined. Once the asset is placed in service, a portion of the asset's cost is allocated to depreciation expense as the asset becomes older. Finally, at the end of an asset's useful life, it is disposed of and removed from the books and records. The accounting for plant assets usually covers several accounting periods. The cost of a plant asset includes the purchase price as well as all costs necessary to get the asset in place and ready for its intended use. The purchase price, net of any cash discounts, is recorded. Keep in mind that finance charges are not included in the cost of an asset. If a purchase is financed over a period of time, the interest cost is charged as an expense when incurred. Let's see how to determine the cost of a plant asset. When purchasing land, the cost includes the purchase price and other costs generally incurred in connection with land acquisitions. Many of these costs are related to obtaining legal title to the land. Also remember that land is not a depreciable plant asset. Land improvements include parking lots, driveways, fences, sidewalks, landscaping, and any outdoor lighting systems. Land improvements are depreciated over their useful life. Whether we purchase or construct a building, the cost should include the purchase price plus any attorney fees, title fees, and repairs made prior to using the building. If the building is built, the cost will include all the necessary construction costs as well as the costs just mentioned. Machinery and equipment are recorded at their purchase price less any available cash discounts. If any special parts need to be installed to make the machinery or equipment ready for its intended use, these costs will be included in the price of these assets. If the company pays delivery charges, these costs are also included in the cost of an asset. Insurance and property taxes are expensed in the current period. They are not part of the acquisition cost of an asset. It is not uncommon to have a lump sum purchase of assets. The most common example may be when purchasing a building and land. Remember, the land is not depreciable, but a building is. A portion of the purchase price must be assigned separately to the building and to the land. When faced with this type of a problem, accountants normally divide the cost between the assets on the basis of relative fair market values. After a planned asset is purchased, the company may incur additional expenditures on that asset. These expenditures may be for repairs and maintenance, overhauls, upgrading the asset, and other expenditures. One way to handle these types of expenditures is to treat them as capital expenditures and charge the amounts to an asset account on the balance sheet. In some cases, the expenditures may be treated as revenue expenditures and charged to current period income as expenses. For each expenditure subsequent to acquisition of a planned asset, decide if the expenditure is to be treated as a capital or revenue expenditure. Generally, subsequent expenditures for ordinary repairs are treated as revenue expenditures and charged to current period income as expenses. Subsequent expenditures that are for betterments are classified as extraordinary repairs. These should be treated as capital expenditures and charged to the asset account. Depreciation is a process of cost allocation. The cost of an asset is allocated to expense over its useful life in some rational and systematic manner. Don't confuse asset valuation, an economic concept, with allocation. The unused portion of the asset's cost appears on the balance sheet. A portion of the cost is allocated to expense on the income statement each accounting period. When dealing with depreciation, you need to understand several terms and concepts. Book value is calculated as the historical cost of the asset minus the accumulated depreciation. Book value is the undepreciated cost of the asset. Accumulated depreciation represents the depreciation taken on the asset since its purchase. Accumulated depreciation is a contra-asset account and is subtracted from the asset account to determine book value. Assets are depreciated as we use them to help earn revenue. As assets are used, they incur physical deterioration and obsolescence. Thank you for watching this video. Don't forget to like, subscribe, and forward this video to everyone who might be interested in studying accounting. I will see you next week.